Hello, my name is Nattapat, and today I am presenting my research titled Federal Reserve Sentiment and Market Prediction, a comparative analysis of RMAX and LCM models across domestic and international equity indices. Financial market forecasting is extremely important but also extremely difficult. Investors, policymakers, and financial institutions rely on accurate predictions to manage portfolios, assess risk, and make strategic decisions. However, markets incorporate new information extremely quickly, making it challenging to consistently outperform simple benchmarks. At the same time, the Federal Reserve, through the Federal Open Market Committee, plays a central role in shaping global financial conditions. Their communications, especially FOMC statements, are known to move markets. With new advances in natural language processing, it has become possible to quantify the sentiment embedded in these policy communications. My research compares two major classes of forecasting models: ARMA and RMAX models, which are traditional econometric models that are well established, interpretable, and computationally efficient, and LSTM neural networks, which are deep learning models designed to capture nonlinear relationships and long-term dependencies, but behave like black boxes and require much more computational power. So the debate in literature are whether deep learning models are superior to traditional econometrics and thus incorporating sentiment from FOMC or Federal Reserve statements improve forecasts. Thus, the objectives for this study is to compare ARMA, RMAX models versus LSTM models across multiple forecast horizons, evaluate whether Federal Reserve sentiment improves predictive accuracy, examine possible international spillover effects in Hong Kong and Thailand, and assess whether model complexity provides real advantages over interpretability. The current research landscapes provide several key insights. Firstly, studies comparing ARMA and LSTM models are highly mixed. Some studies claim that LSTMs outperform ARMA during extremely volatile periods, especially during the post-COVID era. Other studies find that ARMA actually performs better, especially on longer horizons, and is much more efficient computationally. In fact, some research shows ARMA being over 3 times more accurate than LCM for 30-day forecasts. Second, model interpretability has become an increasingly important topic. Cynthia Rudin, a leading researcher in machine learning interpretability, argues that black box models should not be used for high-stakes decisions when simpler interpretable models perform similarly or better. This argument directly applies to finance, where explainability is crucial for regulation, risk management, and compliance. Thirdly, existing studies consistently show that Federal Reserve communications influence markets. Finbert, in particular, has been used to quantify sentiment in FOMC statements, and researchers have found correlations between the tone of these statements and movements in equities, bond yields, and exchange rates. Some studies even show international spillover effects. However, important gaps remain. For example, most studies use only one forecast horizon instead of analyzing short, medium, and long-term horizons simultaneously. Very few studies compare both LDA and Finbert sentiment extraction. International spillovers into Asia are understudied, and most importantly, research rarely evaluates whether model complexity is actually worth it in terms of performance gains. This study is designed to address all of these gaps at once. In terms of the data sources used, this study mainly uses two datasets. The first dataset is equity price data for 5 indices, as shown here: SPY, which is a tracker for S&P 500, DIA, which is a tracker for Dow Jones, QQQ, which is a tracker for NASDAQ, HKEX, which is a tracker for the Hong Kong stock market, and TDEX, or PK, which is an ETF for Thailand's SET50. The period studied is January 2018 to December 2020, which provides around 1,300 trading days per index. The second dataset consists of Federal Reserve communications, including 672 FOMC statements and related policy documents released between 2015 and 2023. And only the data from 2018 and 2022 were used here. All text was pre-processed by removing punctuation, converting to lowercase, and removing English stop words. Before explaining how sentiment was extracted, it's important to briefly clarify what FOMC statements are. The FOMC, or Federal Open Market Committee, is part of the U.S. Federal Reserve that sets interest rates and guides monetary policy. After each meeting, the Fed releases a short statement that sets interest rate, that's summarizing their policy decision and their views on inflation, employment, and risks to the economy. Markets react not only to the decision itself, but also to the tone and wording of the statement. Because of this, analyzing the sentiment of FOMC statements helps us understand how central bank communications might influence financial markets. In terms of sentiment feature engineering, two sentiment extraction methods were used. Firstly, we use LDA, topic modeling, an unsupervised learning technique that identifies latent thematic structures in text. A 5-topic model was chosen based on perplexity optimization, and each FOMC statement was represented as a probability distribution across the 5 topics. The second method was FinBERT, a transformer-based language model pre-trained specifically on financial text. FinBERT outputs probabilities for positive, negative, and neutral sentiment. A net sentiment score was computed from these probabilities. To align sentiment with daily equity prices, sentiment values were matched to the nearest market day, forward filled between new documents, and smoothed using a 30-day rolling average to capture persistent effects. In terms of modeling approaches, as stated earlier, the study uses ARMA and Aramax models along with LSTM models. And for the ARMA Aramax models, the augmented Dickey-Fuller test confirmed that all indices were non-stationary in levels but stationary after first differencing, meaning each series is integrated of order 1. ACF and PACF plots indicate that a first-order autoregressive model was appropriate. Therefore, the baseline model selected was ARMA 110. The Aramax models extends this by incorporating sentiment, which was derived from the FOMC statements, as an exogenous variable. And as you can see here, this is the mathematical equation for the ARMA models. And in terms of strengths, ARMA and Aramax models are interpretable and fast and stable, but they may not incorporate as much data as the LSTM deep learning models. Now, as for the LSTM neural network that was used, the LSTM model used in the study included a 30-day input sentence sequence window, one LSTM layer with 50 hidden units, dropout and batch normalization to reduce overfitting, a dense layer with 64 neurons, and a final output layer that predicts the next price. The model was trained with the Adam optimizer using mean squared error laws and included early stopping if validation performance stopped improving. LSTMs can learn nonlinear dynamics, but they require more computational power and offer little interpretability. As for forecast horizons and evaluation, the forecast horizons of 1, 5, 10, 15, and 30 days were tested. Two evaluation methods were used, the MSE or mean square error method and the Diephold-Mariano test to compare forecasting accuracy statistically. As for the results, between ARMA and LSTM's performance, the results show a clear and consistent pattern. First, ARMA models outperform LSTM models across all 5 indices at the 1-day horizon. The MSE values for ARMA are significantly lower than those of LSTM, and the Diephold-Mariano test confirmed that these differences are statistically significant, with p-values less than 0.01 for every index. Secondly, ARMA also outperforms LSTM at the 5-day horizon. In the US markets, SPY, DAA, and QQQ, ARMA even continues to outperform LSTM at the 10-day horizon. Third, at longer horizons of 15 and 30 days, the differences between LSTM and ARMA diminish, and neither model consistently dominates in a statistically significant manner. These results directly challenge the assumption that deep learning models automatically outperform simpler models in financial forecasting. The second major finding is that Federal Reserve sentiment provides minimal predictive improvement. FinBERT-based Aramax models perform almost exactly the same as ARMA, with only tiny differences in MSE. LDA-based Aramax models perform worse across most indices, especially in international markets like Hong Kong and Thailand. International spillover effects are weak HKEX shows almost no improvement from sentiment features, while TDEX.BK often shows significantly worse results when sentiment is included. Although sentiment sometimes worsens MSE, the absolute changes are small because the models are already performing efficiently. As for the interpretation of these results, they suggest that markets, both US and Asian, efficiently price Federal Reserve information, and the added model complexity does not guarantee improved performance. LSTMs require far more computational power, but do not deliver forecasting advantages. ARMA's interpretability gives it an important practical edge in real-world finance. And as for the conclusions of the study, firstly, complexity does not guarantee better predictions, as LSTM neural networks do not outperform ARMA models for short-term equity forecasting. Secondly, simpler and more interpretable models remain extremely effective, as ARMA and ARMAX are transparent, stable, and computationally efficient, qualities which are valued in professional financial settings. Thirdly, Federal Reserve sentiment has minimal predictive power, as both LDA and Finbert sentiment signals provide little improvement, and LDA often harms accuracy. Fourthly, global markets incorporate Fed sentiment efficiently. There is no strong evidence of predictable spillover effects in Hong Kong or Thailand. Fifth, in terms of the financial institutions, they may benefit more from interpretable low overhead models rather than defaulting to deep learning models like LSTM. In conclusion, this study challenges the belief that more sophisticated models can automatically deliver better results. Instead, it shows that interpretable streamlined ARMA models can outperform more complex deep learning architectures in many practical forecasting situations. It also shows that Federal Reserve sentiment offers limited incremental predictive value, even across international markets. Thank you very much for listening. Goodbye.